At exactly 9:30 this morning, the silver market didn't stumble. It stopped. Not a glitch, not a technical hiccup, a full halt. Prices froze at $98 an ounce, just $2 shy of triple digits, while trading screens across the U.S. went dark. But elsewhere, the market kept moving. Shanghai continued trading above $110. Physical deals were clearing closer to $130. The spread widened in real time. Paper said one thing, reality said another. That halt wasn't about protecting investors. It was about protecting the system. And what happens when that system finally reopens will force a lot of people to rethink what money actually is. Welcome to FactSphare. I know what you're thinking. Another economics channel. But here's the difference. We don't make predictions here. We perform autopsies. And right now, we're standing over a market that just flatlined. If you remember a time when contracts were honored, when markets cleared honestly, when prices reflected supply and demand, then you already know why that subscribe button matters. It's not decoration, it's access. Hit it. Drop a comment too. Tell me where you're watching from. New York, London, Singapore. Because geography suddenly matters again. Markets are no longer global in theory. They're local in practice. Let's get to work. At 9:30 a.m. Eastern, the Chicago Mercantile Exchange triggered what's called a limit halt on silver futures. The price had reached $98 an ounce. Orders were pouring in. Then, silence. Officially, circuit breakers exist to maintain orderly markets. They're meant to slow things down when prices move too quickly. Give traders time to reassess, reduce panic. That's the theory. In reality, this halt didn't happen because silver was moving too fast. It happened because silver was moving too honestly. The market was discovering a price the system wasn't prepared to honor. Futures markets aren't built to move metal. They're built to move paper. Out of every 100 silver contracts traded, only a tiny fraction ever results in actual delivery. The rest are settled in cash. Dollars change hands. The metal stays put. That system works until someone actually wants the metal. This morning, that's exactly what happened. Large buyers weren't rolling contracts or closing positions. They were standing for delivery. Industrial users, institutions, entities that don't want exposure. They want ounces, and there wasn't enough silver to give them. The exchange operates on a fractional reserve model. For every 100 ounces traded on paper, only a small portion exists in vaults. This isn't hidden. It's simply assumed that most participants will never ask for delivery at the same time. Today they did. As buy orders stacked up, market makers quietly stepped back. Liquidity vanished. When sellers disappear, price doesn't drift. It gaps. The exchange faced a choice. Allow silver to reprice sharply higher or pause the market entirely. They chose the pause. But the pause only worked in one place. While New York froze at $98, the Shanghai exchange stayed open. Silver traded freely above $110. Arbitrage should have closed the gap, but arbitrage requires access. And access had been shut off. Physical silver flowed east, not because of politics, not because of policy. Because one market was allowed to function and the other wasn't. This wasn't a malfunction, it was a structural failure. For months, physical premiums had been rising. Dealers charging 15, 20, even 30% above spot just to source real metal. The so-called spot price no longer reflected availability, only confidence. And confidence was breaking. When screens freeze, information doesn't. Phones light up. Dealers call refiners. Manufacturers bypass exchanges and contact mines directly. The number on the screen stays at $98, but the real price keeps climbing. By the time trading resumes, the question won't be if the price adjusts. It will be how violently. Because systems built on promises don't fail gradually. They fail when reality shows up all at once. Legal teams across the commodity complex were suddenly dusting off clauses that hadn't been seriously examined since 2008. Buried deep inside these contracts was the same escape hatch. 3 words: force majeure, act of God. This clause allows an exchange, a clearinghouse, or a broker to cancel delivery obligations when fulfillment becomes impossible. War, natural disaster, government intervention, or something far more uncomfortable, insufficient supply. This is the pressure point where modern commodity markets begin to fracture, because the entire derivative system is built on one core assumption: fungibility. That 1 ounce of silver is identical to any other ounce of silver. That a promise to deliver metal 3 months from now is effectively the same as physical silver sitting in a vault today. Except it isn't. A promise is not a thing. And the market was discovering that distinction in real time. Let's look at the math. Open interest in silver futures stood at roughly 600 million ounces. Registered inventory, the metal actually available for delivery, sat near 40 million ounces. That's a 15-to-1 ratio. 15 promises for every single ounce of real metal. This imbalance had existed for years without incident because most participants never wanted delivery. Hedge funds, algorithmic traders, speculators chasing leverage and volatility. They wanted exposure, not ownership. But that buyer profile had changed. Solar panel manufacturers needed silver for production lines. Electronics firms required it for circuitry. Medical device companies depended on it for antimicrobial components. These weren't traders. These were businesses with production schedules, customers, and contractual obligations of their own. They didn't want price exposure, they wanted metal. And suddenly, a futures market designed for speculation was being asked to function as a supply chain. It couldn't. The trading halt exposed another vulnerability most people never see: counterparty concentration. In silver, just 3 major banks controlled nearly 60% of all short positions. 3 institutions standing between the paper market and physical reality. If silver prices continued rising, these banks faced a brutal arithmetic problem. They had sold contracts promising to deliver metal at far lower prices. If they tried to buy silver to cover those positions, they would push prices even higher, compounding their losses. If they couldn't deliver at all, they would default. Rumors began circulating that one of these banks was quietly seeking emergency liquidity, not from the market, from the Federal Reserve, the discount window. This is where the derivatives architecture reveals its deepest flaw. The system assumes counterparties can always perform, that banks have sufficient capital, that clearinghouses have adequate margin, that risk is distributed. It isn't. Risk isn't distributed. It's hidden. Layers of futures, swaps, options, and forwards create the illusion of diversification. But trace any of these instruments back far enough, and they all terminate at the same choke point: physical delivery. When physical delivery becomes impossible, the structure inverts. Winners become losers. Contracts become liabilities. Assets turn into dust. The clearinghouse had already issued 3 margin calls in the previous week. Each time silver gapped higher, firms holding short positions were required to post more collateral. The logic is simple. If you promise to sell silver at $80 and the price is now $98, you must cover the difference. But here's the problem. What happens when the real market isn't $98? What happens when physical silver is trading at $130? Do you margin against the official price? Or the real one? The clearinghouse chose the official price, because acknowledging the real price would trigger a cascade of margin calls that would bankrupt multiple institutions before lunch. So instead, they halted trading. But halts don't eliminate problems. They freeze them. Imagine a pressure cooker with the valve welded shut. The heat stays on. The pressure continues to build. The lid holding doesn't mean stability. It means the explosion will be larger. Every hour the market remained halted. Industrial users continued consuming existing inventory. Solar manufacturers in California, electronics factories in Taiwan, medical suppliers in Germany. Stockpiles were shrinking. And when those stockpiles hit zero, production stops. The derivatives market was supposed to prevent this scenario. It was designed to send price signals, to allocate resources efficiently across time and geography. Instead, it had become a casino. And the House just admitted it didn't have enough chips to pay the winners. The market would reopen. It had to. But the architecture underneath, the leverage, the concentration, the fractional reserves, none of it would change. The system would reboot with the same flaws that caused the crisis. Only now, everyone knew they were there. And here's the detail that made this unavoidable. A major mine in Peru shut down 3 weeks earlier, not due to strikes, not equipment failure. At $70 an ounce, production simply wasn't profitable. Supply had already broken. Long before the screens froze, the irony is brutal. At $98 an ounce, that same mine could generate healthy profits. But by then, the damage was already done. Operations had been shut down, workers laid off, equipment mothballed. And mining doesn't restart like a light switch. Restarting a silver mine takes months, sometimes years. By the time production resumes, the crisis will already be history. This is the supply paradox most analysts miss. Higher prices are supposed to stimulate production. Economics 101. Demand exceeds supply. Prices rise. Producers respond. The market finds equilibrium. Except mining doesn't work that way. Silver isn't grown in a field. It's pulled from beneath mountains, from depths requiring massive capital, infrastructure, and risk. A mining company can't simply decide to produce more silver because prices jumped last week. The lead time is enormous. From exploration to production, a new silver mine takes 7 to 10 years. Environmental permits, geological surveys, roads, power, water, equipment procurement. At every stage, capital is at risk. And capital is cautious, especially now, because the last time silver spiked in 2011, it collapsed just as fast. Mines that expanded at $48 an ounce found themselves bleeding cash at $15. Investors were burned, shareholders revolted, boards turned conservative. So when silver touched $98, executives weren't celebrating. They were waiting to see if demand would hold, waiting to see if this move was real. While they waited, inventories drained. And on the demand side, something unprecedented was happening. The green energy transition. European governments committed to net zero by 2050. China announced plans to dominate solar manufacturing. The United States passed infrastructure bills mandating renewable adoption. Every solar panel requires silver, roughly 20 grams per panel. That doesn't sound like much until you scale it. To meet climate targets, the world needs nearly 3 terawatts of new solar capacity over the next decade. That translates to roughly 60,000 metric tons of silver per year for solar alone. Global mine production? About 25,000 metric tons annually. The math doesn't work. And solar is just one sector. Electric vehicles require silver for circuitry and battery connections. 5G infrastructure needs it for high-frequency transmission. Medical technology relies on it for antimicrobial properties. Electronics consume it for conductive paste. Every smartphone contains about 0.3 grams. Every laptop around 7 grams. Every EV charging station over a kilogram. The world is electrifying, and electricity requires silver. But here's where the macro picture shifts. Silver exists in 2 worlds simultaneously, an industrial metal and a monetary metal. For the past 40 years, the industrial side dominated. Silver was treated like copper or aluminum. Central banks ignored it. Investors dismissed it. That's changing. When the Federal Reserve expanded its balance sheet by $4 trillion, when the ECB launched unlimited bond buying, when Japan pushed rates below zero, a question emerged. What is money worth? If currency can be created infinitely, if government debt can only be serviced through inflation, if savings lose 5% of purchasing power every year, then what holds value? For a growing number of institutions, the answer became tangible assets, real estate, commodities, precious metals. Silver began appearing in allocation models, not as speculation, but as insurance. Pension funds took positions. Family offices accumulated physical metal. Sovereign wealth funds, particularly in Asia and the Middle East, quietly bought. These weren't traders chasing upside. They were long-term holders building strategic reserves. And they weren't selling at $98. They were buying. Geopolitics added another layer. Roughly 70% of global silver refining capacity sits in just 3 countries: China, Switzerland, and the United States. China has been systematically stockpiling. Not through official purchases, those would be reported, but through state-owned enterprises. Through government-backed banks, through policies encouraging domestic retention. No export bans announced. They didn't need to be. When Chinese refiners prioritize domestic buyers, when export permits slow, when administrative delays multiply, the effect is the same. Supply stays in China. The rest of the world competes for what's left. Mexico, the world's largest silver producer, is watching closely. Politicians there are discussing resource nationalism. Why should Mexican silver be refined in Switzerland and sold to American manufacturers? Why not keep it domestic? Even modest export controls would contract global supply by 20% overnight. The market hasn't priced this risk, because it never does until it's too late. Currency debasement is the final accelerant. At $20 an ounce, it took 20 paper dollars to buy 1 ounce of silver. At $98, it takes 98. The metal didn't change. The currency did. Purchasing power is flowing from paper into metal, not because silver is rising, but because money is falling. And the trading halt didn't stop this process. It confirmed it. The system froze because the market was revealing a truth about currency. And truth is the one thing the system cannot afford. At 10:47 a.m., an email arrived. Subject line, margin call, immediate action required. The recipient was a mid-size hedge fund in Connecticut. They had been short silver since $72. It was supposed to be safe. Historically, silver corrects after rapid rallies. Technical indicators showed overbought conditions. Their models predicted a pullback to $65. The models were wrong. At $98, the fund was underwater by $26 per ounce. They held contracts representing 5 million ounces. The loss? $130 million. And the market was halted. They couldn't close the position. They couldn't buy back contracts. They couldn't stop the bleeding. All they could do was watch prices in Shanghai climb higher and calculate how much worse it would get when New York reopened. This wasn't isolated. Banks were exposed too. Market-making institutions don't bet directionally. They manage portfolios, offset risk, maintain what they call delta-neutral exposure. In theory, they can't lose. In practice, theory breaks. One multinational bank held an estimated 200 million ounces of silver short exposure accumulated over years of routine market making. Their hedging assumed liquidity. It assumed physical supply would always be available. Both assumptions failed. Dealers quoted $130 physical. Contracts required delivery at $98. The gap was pure loss. With 200 million ounces of exposure, the loss approached $12.8 billion. more than the entire commodity division was worth. Bankruptcy stopped being theoretical. Credit default swaps spiked. Bond investors noticed. Equity analysts downgraded. Counterparties began pulling back. This is how contagion starts. Not with headlines, with phone calls. We're reducing your credit line. We need additional collateral. We're closing our prime brokerage account. Each move is rational. Together, they create a death spiral. Liquidity falls, confidence collapses, withdrawals accelerate, intervention becomes inevitable. But bailouts in 2025 are politically toxic, so the rescue has to be quiet. Discount windows, emergency facilities, swap lines, billions injected without votes, headlines, or accountability. And this is where force majeure returns. Buried in futures contracts is language allowing exchanges to alter settlement terms under extraordinary circumstances. If delivery becomes impossible, if regulators intervene, the exchange can mandate cash settlement instead. And here's what that means. A buyer holds a futures contract entitling them to 1,000 ounces of silver at $98. They expect metal. Instead, the exchange declares force majeure. The contract is settled in cash. The buyer receives $98,000, but physical silver is trading at $130 per ounce. The loss? $32,000. Not because the buyer made a bad trade, because the rules changed. This isn't hypothetical. The precedent already exists. In 2022, during the nickel crisis on the London Metal Exchange, billions of dollars in trades were canceled retroactively. Positions were unwound at prices that no longer existed. Traders sued. The exchange won. Courts ruled that systemic stability outweighed individual contract rights. The same logic applies here. If enforcing silver contracts would bankrupt major banks, if those bankruptcies would trigger contagion, if contagion would threaten the broader economy, then contracts can be rewritten for the greater good. This is the moral hazard embedded in modern finance. Institutions take enormous risks because at some level they know the outcome. Profits remain private. Losses are socialized. The trader who bets wrong keeps his salary. The bank that overleverages gets rescued. Executives approve the strategy and still collect bonuses. The cost is paid by everyone else, through inflation, through currency debasement, through the quiet erosion of purchasing power. While traders and banks were scrambling, pension fund managers were facing a different nightmare. Their portfolios were built on tradition, 60% stocks, 40% bonds, maybe 2 or 3% commodities. Silver, less than 0.5%. And now silver was the best performing asset of the year. Stocks were flat, bonds were losing value to inflation. The one asset surging was the one they didn't own. Fiduciary duty demands action in the best interest of beneficiaries. But how do you explain to retirees that you missed a 300% move because silver wasn't in the benchmark index? Pressure began to build, pressure to chase performance. But chasing performance at $98, with the market halted, force majeure on the table, and physical supply evaporating, requires conviction. And conviction requires understanding. Most didn't understand. They saw a price spike. They didn't see a system failure. The halt would be lifted. Trading would resume. Prices would be discovered. But the mechanism discovering those prices, a derivatives system built on fractional reserves and counterparty trust, had revealed itself as fragile, fundamentally fragile. Some institutions would survive, others wouldn't. And the difference between survival and failure would come down to a single question. When the screen unfreezes, are you holding paper or metal?